Welcome to the Me the Money Show. I'm Dan Barnes, Editorial Director at Markets Media Europe, and joining me is Lynn Strongin Dodds, Editor of Best Execution. Welcome back to the show, Lynn.
Hi, Dan.
So tell us, we've seen a lot in the news recently about the Libor transition. Is that still going ahead despite COVID-19? And what are the latest developments there?
Yes. Okay. Well, this is like the never-ending Libor story. There have been so many debates and discussions, and I think perhaps wishful thinking that COVID would see the deadline for the Libor transition be extended. However, market participants have been very disappointed because this week the Bank of England and the U.S. Federal Reserve has confirmed that the end of 2021 deadline will not change and that everyone should have their plans in place now. Bank of England Governor Andrew Bailey and John Williams, who's the head of the Federal Reserve Bank of New York, were speaking at a webinar this week called Libor Entering the Endgame. Bailey acknowledged that there had been several calls since the coronavirus pandemic escalated to extend the shift to the risk-free rate from Libor. But he said, in my view, what we saw in financial markets in March in response to the shock of COVID only reinforces the importance of removing the financial system's dependence on Libor in a timely way. And Williams said, it doesn't matter whether you're a large global bank or you're a small company with a handful of employees, you need to be prepared to manage your institution's transition away from Libor. And as he said, let's not make the existing hole, we're trying to climb out even deeper. To make matters worse, I suppose, for market participants who are hoping for an extension, the Financial Stability Board, a global body for regulators, cautioned there would be a significant negative impact if authorities do not prepare for the end of Libor because many existing contracts are due to mature after 2021. Now, currently, the market has only seen a slight shift. The International Swaps and Derivatives Association first quarter report showed that the traded notional of interest rate derivatives, or IRD, referencing the RFRs, was 8.4 trillion, which is about 9.6% of the total IRD traded. Now, this was higher than the 2.7 trillion in the fourth quarter. However, this is a proverbial drop in the bucket, as Libor today stands at roughly 350 trillion of various financial instrument contracts benchmarked against it. Also, the UK is farther ahead than the US. So its sterling overnight index average, or SONIA, linked IRD notional traded, was surged 237% to 8 trillion compared to the US secured overnight financing rate, which only reported a much more modest 68.9% hike, just totaling 280.4 billion. Now, the main reason behind this difference is that SONIA is a much more established, liquid, well-known RFR, having been introduced in 1986. So market participants really know when they're trading, what it's all about. However, SOFR was only introduced and came on the scene in 2017.
Yeah. That's great. Very interesting. And I saw that there have been some calls for regulatory intervention on the whole Libor discussion,
yes.
But some pushback against that as well.
Yeah, there's a very real, they were saying, I've spoken to some market participants who are not affected by it, who just said, with all the regulation and with all the pushing going on, Andrew Bailey made it very clear when he was head of the Financial Conduct Authority that 2021 was the end date.
That's great. Thanks very much. And then talking of benchmarks, I think we've seen a few developments on the criteria around ESG this week. And there was a report, I think, from BNP Paribas. Could you tell us a bit about that, please?
Yes, this really gained traction in the COVID period, and people are really focusing on it. But E and G were the main focuses, and the report showed that the S, or the social component of ESG umbrella, has become much more important in the investment decision-making process and the research. However, as with all ESG criteria, the absence of uniform metrics combined with data availability creates significant barriers. And this was the report by Greenwich Associates on behalf of BNP Paribas Asset Management. The study polled 96 institutional investors and 33 intermediary distributors in the UK, France, Germany, Italy, the Netherlands, and the Nordic countries during June. it found that while around 37% of respondents saw no barriers, 42% cited the lack of established standard metrics, and about a third mentioned the lack of clarity over what socially responsible investing actually includes. And you can actually see this in the recent example of retailer Boho, which saw its share price knocked by around 15% when it was discovered that its employees were on low wages and operating in poor conditions. It sold itself as a bastion of ethical practices, which is why there needs to be better data and transparency to assess the real situation. I mean, overall, the studies show that ESG is gaining traction. 81% of the respondents already employ ESG criteria, and all are part of their portfolios and research, and the rest plan to do so. The E and the G remain the most important elements of investment approaches, but the social aspects are really gaining traction. So, for example, 79% of those canvassed stated they can have a positive impact on long-term investment and risk management. And this is a 20% increase hike from the period before. And if you look at the environment, there was only 11% jump. And if you look at governance, it was just a 4% rise. Now, going forward, respondents plan to significantly increase the use of social metrics. About a half already use exclusionary criteria, with around a third planning to follow suit. And around 30% also use labor standard metrics, and again, the same percentage expecting to incorporate them. Social metrics typically include a company's treatment of its employees, as well as its impact on the wider society through its relationship with customers, suppliers, and local communities. They not only focus on how a company curbs potential damage, but also how it creates social benefits. Assessing the criteria, though, can be more challenging than, for example, the environment, which tends to focus on reducing harm, or governance, which often operates within existing legal or stewardship frameworks. Now, the authors of the report say that while social factors are an extremely important component of companies' ESG scores, they have often been perceived as less prominent. And this can be attributed to the nature of the social indicators that can be less tangible or measurable. Now, one example in the UK we've had is retailer Boho, which saw its share price knocked by 15% when it was reportedly and allegedly discovered that its employees were on low wages and operating in poor conditions. It sold itself as a bastion of ethical practices, which is why there needs to be better data and transparency to assess the real situation, according to the findings of the BNP Paribas report.
And then finally, going back to the derivatives space, we've seen calls this week for the exemption of derivatives trading from the securities deposit regulation, part of the central securities deposit regulation, I believe.
That's right, yeah.
Can you tell us how's that being, what's the angle there?
Well, they put out a position paper. So the Futures Industry Association and ISDA are calling on European regulators to exempt derivatives from the settlement discipline regime, or the SDR, of the Central Securities Depository Regulation, because they argue they're already covered in existing rule frameworks. And in the joint position paper, the trade bodies state that they are concerned that the SDR, or the settlement discipline regime, was not drafted with derivative transactions in mind, and that applying these requirements would overlap with and undermine the risk mitigating purpose of the derivative-specific requirements, such as margin rules, which are seen in the European Market Infrastructure Regulation, or EMIR. Now, the CSDR, which aims to improve the settlement process, has been delayed several times. The most recent one is until February 2021 from this September. Two of the most contentious issues are the mandatory buy-in regime, which will be initiated in the event of a transaction failing, and the SDR, which introduces fines. The settlement fails when securities are not delivered. The paper notes that the derivatives may fall under the scope of the SDR when transferring margin or when physically settling a derivative contract where the underlying is an in-scope financial instrument. However, the trade bodies explain that mandating a buy-in or imposing a cash penalty, where a transfer of such financial instruments as margin fails to settle, would actually likely to increase the receiving party's exposure to the posting failing counterparty. They say this would have the exact opposite effect to the risk mitigating purpose of the regulatory margin requirements of EMIR. And they say that the timing of daily margin requirements would also render a buy-in ineffective in this situation. Both
Yeah,
trade bodies acknowledge that CSDR and the ramifications have been around for a very long time. But I think what's happened is that market participants who've been very busy with other regulation and COVID are actually now just kind of focusing on what are the nitty gritty details in this regulation. And as a result, the trade bodies are asking EU regulators to step up the pace to make a quick decision, which in my experience typically is not usually the case with European regulators
yeah,
regarding
quite.
the position on whether derivatives fall within this jurisdiction of CSDR. And then they're saying if they don't, they request them to alternatively consider an additional delay to allow more time for analysis into the various red flags that they have just raised. I'm not sure actually if that either is going to happen. So, the jury's out as to what the European Commission is going to do with this.
That's been great. Thanks very much, Lynn. Excellent.
Pleasure. Thank you.